Long-term care planning is like flossing your teeth. Everyone knows they should do it. Nobody wants to talk about it. And eventually, ignoring it gets very expensive. I wish I'd been more of a burden on my kids, said no one ever. I'm glad I didn't get long-term care insurance as they wheeled me into a nursing home, said no one ever. I'm Mike Samet, money mentor, an IBC specialist, and a long-term care specialist. You're listening because you're either practicing infinite banking or considering it, building wealth, eliminating the bad debt in your life, just looking for ways to be more efficient with your money. If you're practicing infinite banking, taking those loans, eliminating that bad debt, putting the money to work for you in private money club or whatever you know, like, and understand, growing your net worth, building generational wealth, well, long-term care insurance will protect what we are creating with our banking system. I call it portfolio insurance or protecting the vault. Long-term care insurance will not make you rich. It will prevent you from becoming poor. I'm going to say that one more time. It will not make you rich. It will prevent you from becoming poor. What's the first thing you thought about when you first heard of infinite banking concept? It's the first thing I thought about, and the number one thing I hear on strategy calls with clients is, I wish I would have known about this sooner. In 30 minutes, you will know about long-term care. So that will not be an excuse for you. Now, this is something you probably won't need for 20, 30, 40, or 50 years down the road. You must be at least 35 to get a policy, and you can go up to age 80. We can get some of these annuity products to work at 87, but for the long-term care, 35 to 80. Now, if you're younger than 35, I assume you have parents that are 50, 60 age range. Do you want to care for them? Do you want to bathe them, dress them, feed them? Now, Chris Noggle got a policy on his mom years ago. Now, he didn't do it for his mom. He did it for himself, his wife, his daughter. So they won't be responsible for caring for mom, mother-in-law, grandma, or the cost of care associated with it. Chris is busy running multiple businesses and putting out content for you folks on a daily basis. So caring for his mom is not Chris's superpower. He protected his lifestyle and his family's lifestyle by getting a policy on his mom. I know it's something we don't like to talk about, things that are going to happen way down the road, and uncomfortable things like long-term care and death. My wife and I just had a death conversation the other day. I told her I wanted to be cremated, and she made an appointment for Tuesday. All right, let's dive in. One choice can impact generations. You are only one choice away from changing your life and the lives of those you love. So we're going to talk about today, what is long-term care? It has many names. We're going to go over some facts and figures. I want you to understand what we're looking at now and in the future, the impact on families and the emotions involved, impact on finances. Care is not inexpensive. And we're going to go through a few examples. So what is long-term care? It's often referred to as custodial care, long-term care, or extended health care. It's not just a nursing home. That's the first thing that comes to mind, the stench of death in a nursing home. It's also home health care, adult daycare, facility care, informal care, and many more. When do long-term care benefits kick in? When you cannot meet two of these 6 activities of daily living: bathing, eating, dressing yourself, transferring, moving in and out of bed, using the bathroom, or continence, or have a severe cognitive impairment. All right, this slide shocks a lot of folks. These are some national average cost of care from last year, 2025. Lowest to highest. So the most inexpensive is adult daycare, dropping your folks off at a facility. It's going to run about $25,000 a year. Again, national average is going to vary depending on where in the country you are. It's usually more expensive on the coasts East Coast, West Coast. I'm in St. Augustine, Florida, and this aligns pretty closely to where I am located. Assisted living facility, you're looking just under 75,000. Home health aid, $80,000 a year for 40 hours a week of care. Now, once people need more than 40 hours, usually more cost effective to move into a nursing home. And a semi-private room, sharing a room with a perfect stranger is going to run about 115,000 a year. If you do proper planning, and can afford 130,000, that'll get you a private room. Now, this is just 1 year of care. So here's some facts and figures we're going to go over. Again, it's not 1 year of care. The average for men, 2.2 years. For you females, 3.7 years is the average length of care. Now, for Alzheimer's, 8 years. Now, how do we get an average? Just add up everyone on care, the length of care, and divide by the number of people on care. You get an average. Doesn't usually tell the whole truth. It's the worst case scenario that wipes people out. So this company, AALTCI, did a survey, interviewed 7 large insurance companies, asking them, what was your longest claim for a male and female? So we learned a few things from the survey. They were offered the clients unlimited care, most likely. They had that service available to them. Some companies only go 2 years. Well, then insurance company wouldn't know how long you're going to care if they got to move out of facility in 2 years, because that's all they're going to pay. So these companies had an unlimited benefit. We can also assume that all these people had a cognitive issue, Alzheimer's, dementia, Parkinson's. And then when it comes to gender, this is very interesting. So we saw on the slide before, average length for a male, 2.2 years, female, 3.7. So in 5 of these 7 cases, males were on care longer. So look at some of these long cases, 14 years for the male, 16 and a half years for the female, 19 years for the male, 15 years for the female, and the costs are over $2 million. This could wipe people out. Some trends we're paying very close attention to in the industry, as this has a huge impact on cost. There's 10,000 people a day turning 78 in this country. The baby boomer generation. They're not going to need care today, but they will very, very soon. And there's a whole wave of people coming right behind them. So it's a simple supply and demand situation. The silver tsunami is coming. We're living much, much longer these days, and medical technology is doing great things for our body. Minds, not so much. So huge increases in Alzheimer's, Parkinson's, dementia cases. We expect this trend to continue. Family dynamics. Most parents don't want their children putting their lives on hold for care. They're moving away. They're not living in the same city. Parents retire to Florida. Kids get a job in another state. So typically they're not even there anymore. So who's going to care for the parent in that situation? And the government, what programs will be available in the future? Well, who the hell knows with the government? So I don't think anyone listening to this is going to depend on the government for anything. So my last set of stats, 70% of everyone listening to this will need care at some point in your life. In those on care, 20% will need it greater than 5 years. If you're a couple, husband, wife, the chance that one of the two of you will need care, 91%. So if there's a 91% chance of rain, I'm taking my umbrella. Now I know what you're saying. You're going to be in the 30% or the 9%. I hope you are, but what if you're not? So again, you might not need care, but if you do, I'm going to ask you a very important question. How will it impact your family? Really think about this. Fast forward to age 90. You need help. You cannot perform 2 of those 6 activities of daily living, or you have a severe cognitive impairment. Think how it will affect your wife and kids. Starting with the spouse, the emotional impacts. So the healthy spouse has to give up their hopes and dreams to take care of you. I'm not going to do that to my wife. I don't want her to give up playing pickleball to care for my sorry self. She already said she's not going to wipe my 95-year-old ass. I'm like, well, that's fine. I'll hire a hot 70-year-old to do that. Physical challenges. My wife can't pick me up now. Can't imagine her even attempting to as a frail 90-year-old. And the obvious financial impacts. If I have to go into a facility at 130,000 a year, what's that going to do to her lifestyle? It's a new bill in the life. The impact on children. I don't want to be bathed in my parents, and I certainly don't want my kids bathed in my 95-year-old self. Scar them for life. Will not repeat. I will not be a burden on my kids. They have their own lives, jobs, careers, families. I would never ask them to put that on pause to care for me. And I wouldn't want to do that for my parents either. Adult siblings. I've seen this firsthand, the fighting amongst siblings about who's going to care for mom and dad. Oh, you're on duty. No, you're on duty. This isn't fair. Rips families apart. Tension, resentment. Do you get along with your siblings? And if you're single and have no family nearby, you'll need a plan. Who will be designated to care for you? And are they willing and able to accept the responsibility? What's your plan? And the other question I want to ask you very seriously, if care is needed, how will you pay for it? Three ways to pay. Taxpayer assistance. Again, are you going to depend on the government? I don't depend on the government for anything. Medicare is insurance. People get it confused with Medicaid a lot of times. Medicaid, you need to be impoverished for Medicaid to kick in. And then you're at the mercy of where they're going to let you stay. I want choices. I want options. I will never depend on the government. Traditional long-term care insurance. I applaud anyone that gets this, transferring the risk to an insurance company. Very, very smart move. However, the traditional policies, they're starting to jack up the premiums to the point where they're unaffordable and people need to lapse their policies. And if they are in the lucky 30% don't need care, they lost everything they injected. So it's a use it or lose it scenario. Not the best option, but if you have none of these, you're going to be paying out of pocket by default. We're going to dive into this a little deeper. Personally, I'm transferring risk to an insurance company. I had a prostatectomy a few years ago, could have paid for it out of pocket, cost about $100,000, but I transferred risk to Florida Blue Insurance, and they paid the majority. They paid a couple $1,000s, small price to pay to be cancer free. So the impact on finances at a little deeper level. As we noticed, this is not a one-time payment. This is a monthly bill. So just take, for example, your average couple retired living on $100,000 a year. Now there's a new bill. There's a new $100,000 bill. Where are you going to get that money? You have to fill that $100,000 gap. So you're going to have to sell some assets. What are you going to sell first? Are you going to sell it at an opportune time? Are you going to sell real estate in the horrible market like we're having now? Are you going to sell stocks when they're low? And if the stocks are high, are you going to sell and incur a tax liability? Are you going to dip into more of your retirement funds, generating a tax liability? You're going to take away from your children's inheritance by dipping into any of these things. Are you going to assume more risk with your investments in order to meet this income gap? If income goes up, Medicare premiums go up. So it's a ripple effect, a death spiral, if you will. Long-term care is an income problem, not an asset problem. So this is an example of somebody's portfolio. You have a conservative bucket, moderate bucket, aggressive bucket. So let's say you didn't have a policy and you wanted to start one. Pull money from an accessible bucket. Let's say savings account, CD, policy, anywhere access to it quickly. So we're just going to reposition it. Government says we can just reposition it, move it from one pocket to another. Still yours. We're just moving it for tax incentives. Now we're turning this small amount into a larger amount via a death benefit, the life insurance death benefit. What America goes a step further. They're offering lifetime coverage, not just for one person, but if you happen to be a couple, lifetime benefit for two people. So important to have this lifetime benefit. You don't want to have to move out of a great facility when you run out of money. This could never be an issue in this case. You could live to be 200 years old. They're going to pay for it. One America will pay for your care until the day you die. So we are carving out a little piece of the pot to protect the whole pot. It's portfolio insurance. It's my retirement lifestyle. It's my everything insurance. This is by far the biggest expense we'll face in our final years. Oh, and it's not just for old people. This could happen to younger people with cancer, car accident, stroke. My cousin's girlfriend had a skiing accident, ran into a tree, paralyzed from the neck down. We'll need care the rest of her life. All right, if you haven't been paying attention so far, stop what you're doing, stop multitasking, and listen. This diagram is going to explain how the concept works. I think you all understand what happens when you die. Beneficiaries get a death benefit. But if you need care, this is how it works. So this is the timeline. You have your base policy. This is your cash value. This is your death benefit. So you go on care. You're going to use up this amount of money first. And as we saw in previous slides, that's going to go pretty quickly. Let's just say, for example, this is $100,000. Once that's gone, this lifetime rider is going to kick in. And it will pay for care for you, if you're married, your spouse, forever. Again, it will not make you rich. It's designed to prevent you from becoming poor. Wealthy folks have figured out how to not to give the money back. I don't know any truly wealthy folks that don't have long-term care insurance. Wealthy people understand the tax code and how to minimize taxes legally. They understand leverage, how to turn pennies into dollars. Now we're going to go through a few examples. Stacking with income or savings to fund a policy. You could fund similar to your specially designed and engineered whole life policies, monthly, quarterly, semi-annually, or annually. Or you could pay with qualified money, IRA, 401k. All right, we'll start with the stacking strategy. I know many of you have multiple life insurance policies. So how many life insurance policies does a person buy over a lifetime? Usually quite a few if you're doing it right. So same thing could happen with long-term care. You don't have to get it all at once. So in this example, we have a 40-year-old couple. It's just starting out. So for $1,300, $1,351 a year, they can get a benefit of $24,000 a year, $2,000 a month each, $2,000 a month for the female, $2,000 for the male, $50,000 death benefit. Again, not why we're doing it, not doing it for the death benefit. It's just there if you don't need care. So just a little over $100 a month. Not going to pay for a nursing home, as we saw in previous slides, but it's a good start, great start. So let's say 5 years passes, got a kid out of college, there you have another $1,600 a year available. Policy number 2, same benefit, $50,000 death benefit, $24 premium. You can get as many as you want. You can stop at 1, get 2, 3. In this case, it's 4. So now we have a significant amount of benefit here. $96,000 a year for the husband, $96,000 a year for the wife. If they don't need care, $200,000 goes to the beneficiary of their choosing. All right, funding with income or savings. Again, monthly, quarterly, semi-annual, or annually. In this case, we got a 6-year-old couple, I believe, paying $10,000 a year for almost $169,000 of benefit. Again, not why we're doing it. We're doing it for these numbers down here. So once this $160,000 is exhausted here, lifetime benefits kick in. At $84,445 a year for the husband, same amount for the spouse, making pennies work like dollars. Repurposing qualified retirement assets. Great strategy if you have money in your retirement accounts. A lot of folks accumulate a lot of money. I did all that traditional stuff, maxed out my 401k, turned 50, did the catch-up contributions, grew nicely. Now I want to get some of it out of there before I have to take it out with the RMDs. I hate when someone tells me what I can and cannot do with my money. At 75, the government says you have to start pulling money out of your IRA. So what a great strategy is, carve out a little piece of it. Let's say $150,000, put it into a plan. Well, One America is going to give you a 25% bonus to do this, or $37,500. So giving you a total of $187,500 going into an annuity. Now, this annuity is going to buy your long-term care over a 10-year period at $18,750 per year. This will be taxable. Again, you're not paying tax up front on all this. You're going to just spread it out over 10 years. So it shouldn't jump you up a tax bracket. Again, this money is going to have to be taxed anyway. But now the growth of all this money, let's say you need $2 million of care, all that money's paid tax-free. Very, very powerful strategy. Here's how it looks like on the timeline. You inject $150,000 for the $166,000 of death benefit for this. This is the real reason we're doing it. $83,208 for the husband, same for the wife. That is the power of long-term care insurance. Now you know about IBC. You are only one choice away from changing your life and for those you love. Now, remember those two questions I asked you. How would it impact your family and how will you pay for it? Is there a plan in place? Love this quote by Warren. If poor people would just do what rich people do, they wouldn't be poor anymore. To wrap up, I just want to let you know the reasons my wife and I decided to acquire One America Asset Care Policy. We didn't want to be a burden on each other. We didn't want to be a burden on our kids and future grandkids. We didn't want to pay for our own care. We're transferring risk, or we transferred risk to One America. We didn't want to use up the death benefit utilizing the chronic illness rider on our specially designed and engineered whole life policy. That money is earmarked for our children, and I will not be taking money out of their hands. We love the fact that we can turn $1 into $15 tax-free. Now, One America has an amazing plan. Can never raise premiums, written about 6 places in the contract. If either my wife or I go on care, premiums are waived. No, not half premiums, no premiums. Now, if we come off of care, then premiums would resume again, but that rarely happens. Once people go on care, they typically don't come off of care. And if we are in that minority and don't need care, our kids will get a death benefit. So it's not a use it or lose it scenario. So based on the statistics we have, the 91% probability that one of us will need care, this was and is the right move for us. So reach out if you have any questions. I would love to talk and chat about it or provide you with an illustration. Thank you for listening.